Hello, welcome guys. Today we are representing FIN500 Financial Management Assessment, the Investment Analyze and the Financial Decision. So let's start with the first slide. It is an investment decision and the financial analysis. Let's move to the content which show in first part is introduction and second is section 2, 1 and third part is section 2 as we go like in the Introduction. Investment decisions are those decisions which are needed for the acquiring assets and funds requirement for those assets along with analysis of its future benefits. For example, valuation of the business and M&M preposition with the key assumption along with its relevance in the capital budgeting. Let's move to the another slide, which is section 1. Section 1 evaluation of the project is done by using different techniques. The techniques used for an analysis and the net present value, internal rates of return, discontinued payback period and profitability index. After that, it is a decision based on the analysis is suggested. Sensitivity analysis is also done as per the given instruction. Let's move to the another slide, which is the net present value capital budgeting techniques. The net present value is calculated by subtracting the total value of the cash inflow from the total value of the cash outflow. Net present value is the value of cash flow, whether inflow or outflow for the whole life of the investment which is discontinued at the present. The decision can be taken easily. Analyzing the net present value. Let's move to the another slide. This slide is IRR, internal rate of return. The discount rate which makes the net present value of the project makes zero is the internal rate of return. We can say that the internal rate of return is annually compounded rate of return that will be earned on the investment. The internal rate of return The internal rate of the return is the best suitable where more than one investment is an option and decision making should be done for selection one of the companies. Let's move to the another slide. This slide is the year until break even plus unrecovered amount divided recovered year cash flow. As we show in the picture, discounted payback period. Discounted payback period tells the period after which the recovery of the investment starts. Here only the cash flow are taken into the consideration and the other irrelevant data is not included. The discounted payback period is necessary because it is the method time is calculated after which the point of the time the project will be get removed like the initial investment. The time value of the money is not considered here. Thank you.
Next slide is profitability index. The profitability index helps in giving ranks to the investment and then decision making taking place. If the value of the profitability index is more than 1, then the investment should be accepted and the investment will help to earn more profits in the future. But if the value of the profitability index is less than 1, then it means that the investment will not earn profits. It indicates loss to earn from that project whose profitability value is less than 1. And if the value of the profitability index will be equal to 1, then there will be no loss and no profit. The situation in this condition will be break even. The only invested amount will be recovered and no excess recovery, which will thus contribute to a no profit or no loss scenario. The calculated profitability index is more than, which means project should be accepted. It is expected that the project will earn more profits in the future. The next slide is decision making. So after analyzing all the techniques, the suggestion is that the project should be accepted or not. So this is the process of decision making. However, the internal rate of return is not so high here, but according to all other techniques, the project is profitable and will help the organization to grow more.
Hello everyone, my name is Navjot Kaur and my student ID is 20173039. This is a section 2 of group presentation. In this section, It was instructed to write an essay on the valuation of business with reference to public and private company. Also, preposition of M and M is also described in the essay. Their key assumptions are also mentioned with its relevance. Valuation is a process in which the determination of a company or assessed or investment's present value is being done. There are various approaches for valuing the company or assessed worth. However, the process of valuation takes place when there is a plan of selling part or the whole business. But for other reasons, valuation can be done also, like for borrowing or expansion of business. Valuation tells shareholders and other investors about the estimated worth of the business of the company by analyzing all aspects. The process valuation of business includes analysis of management, the structure of capital, expected future earnings of the value and assess in the market. Next is there are different approaches for valuation of the business in case private companies. In private companies, the process of valuation is used to determine the intrinsic value of business run by a private company. In the case of public companies, valuation can be done easily with the help of value of share and outstanding share the files. Market capitalization is market value of the public company, which can be calculated by multiplying share prices outstanding shares. The private company did not maintain their accounts or follow standards like a public company and thus very difficult. It is one of the easiest approaches for the valuation of the business. This method or approach is considered on one of the least accurate approaches or methods for process of valuation. Book value can be calculated by subtracting total liabilities from total assets. It can be given idea about the worth of the company to stakeholders if the business would be sold today. Thank you.
Hello, my name is Jasprit Kosra and my student ID number is 20173013 and my slide is discounted cash flow method. It is one of the interesting approaches for calculating the value of the business. The famous concept of weighted average cost of capital is used in this approach. The approach needs extensive data and analysis. This approach is detailed approach from the other approaches and there is the requirement of extensive assumption and estimates. It is one of the least accurate method because there are many input used in this. The weighted average cost of capital is considered an effective discount rate in capital budgeting. The unlevered free cash flow can be calculated by using the formula in this slide. The valuation of the business by using the approach require high knowledge and experience in financial modeling. All the costs are cost of equality, cost of debit, tax rate and texture of capital must be known for calculation of valuation. The approach for public company. For the valuation public company, market capitalization is used. Market capitalization method cannot be used in private companies. Market capitalization is one of the common approaches through which shareholders and can determine and risk involved in the business operated by particular company. In the market capitalization approach, the formula used in approach is as follows: MC is equal to N multiply P. Here MC stand for market capital, N stand for number of outstanding shares, P stands for the market price of share of considered company. This approach is one of the universal method used in many countries for evaluation of the business. Because of its universal nature, stakeholders easily understand the calculated value of the business. It is one of the precious approach in the evaluation of the value of the business. The index is given to various companies. Companies that have high value on market capitalization gain better weight in this index is given to various companies. Companies that have a high value and market capitalization gain better weight in the index of the companies. The comparison among companies can be done better because this method is universally accepted and apply only the public companies. This method or approach plays no role in the comparison of private companies. This valuation approach is very convenient, but in this approach, all other factors are not taken into consideration. In this approach, assets and borrowing are not considered. So, with the help of this approach, value of the business of the public company can be calculated very easily as stocks are listed publicly. The next slide is Modigliani and Miller pre-positions. For a better understanding, the company structure of the capital, its value, and the cost of company, Modigliani and Miller have made important contribution. The main conclusion of their proposition is that if there is not any tax present, then the structure of the capital for the organization is not relevant, and if taxes are present in the cost of the capital of the organization can be lowered by increasing the borrowing instead of issuing equity. Borrowing or debit act as a shield against taxes. Modigliani and Miller have proposed two propositions, and for both cases, propositions are there that are with tax and without tax. The proposition is as follows. The proposition 1, in this taxes are not present and there are no costs of transactions. As per this proposition's costs for both types that are levered and unlevered are the same. Proposition 2, in this proposition cost of borrowing are not more than the cost of a guarantee. Proposition 1 with taxes. Here, borrowings that act as a shield for a company against taxes. Proposition 2 with taxes. In this proposition, there is positive relationship between the cost of a guarantee and borrowings. The cost of a guarantee will be less if there will be no tax. Assumption made by the Modigliani and Miller are as follows. Number one, the type of market will be perfect capital market. There are no restrictions on the purchasing and selling of the shares. Investors or shareholders' cost of borrowing will be same as cost at which they allow borrowings of others. It means that the cost in all cases will remain the same. There will be no transaction cost. Home, homes levers and corporate levers will be same. Risk is second. Number two, risk associated with different decision will remain the same for all the organization and stakeholders. Number three, the organization does not need to pay taxes. There will be no tax saving from the interest which is paid for of the borrowings. Thus, tax deduction are not there. The company will pay full dividends on the shareholders. Whole earning will be distributed to the shareholders. There will be no savings from net income as reserves. The theory of Modigliani and Miller explain that relationship between factors and this theorem tell about how a manufacturing industry acquired its funds and operate its activities. The theorem of the Modigliani and Miller is very important for decision making in the manufacturing industry. The next slide is validity of M&M proposition under thin. The thin capitalization rules being operated by either of the approaches are as follows. Determination of the maximum amount of borrowings on which interest are deducted. Determination of the maximum amount of the interest that will be deducted considering interest payable on another variable also. No proposition made by Modigliani and Miller are not valid under the thin capitalization rules. As per the thin capitalization rules, excess borrowing will be available for tax savings. There are various approaches under the thin capitalization rules like the arm's length approach or the ratio approach. The next slide is conclusion. The sensitivity analysis tells about the impact of the changes in the dependent factors which will thus affect further dependent factor in the different scenario. So sensitivity analysis tells about the various possible condition if there will be changes in the independent factors and how much this change will affect that dependent variable. So in the problem, different scenario are given and we have to conduct sensitivity and analysis on the given scenario. If we talk about operating cost which will remain the same in percent percent, then it will thus affect a dependent variable. The discount factors will always change, and thus factors will be changed. There will be change in decision making also. The value of is not present value will also change, but changes will be tolerated at a certain range, and after that value of net present value by become natives. Hence, insensitivity analysis also tells about a range of tolerance. It tells about how much is the sensitive factors, and its this sensitivity can be adjusted at which level. If the project weighted average cost will be equal to 9.445%, then discounted will be different, and thus other values also change, resulting in changes in other calculating using different techniques. So the decision making can also be affected if the company's tax rate will change. The value which is calculated of the after the conduction of tax rates will also be affected through sensitivity analysis. Other process of business are decided. With the help of sensitivity analysis, the strategies of the business will be amended. With the help of a sensitivity analysis, the predictions can made for the shares which are publicly traded in the market. So sensitivity analysis is also done for the corporate governance methodology. Impacts of other interest rates on the price of bonds are also defined in sensitivity analysis.